Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, what I've illustrated here is a strategy. Again, it's referred to as the butterfly because this is the body and these are the wings, right? So this is, you guys can kind of get a picture as to where this strategy sort of gets its name. Now, the challenge for this strategy is that there is a very sort of very well-defined point at which we reach our maximum profit. So if we're looking at trying to maybe widen that target, if you will. Right now our target's at 107, but if we're looking to widen our target, what we can effectively do is we can widen the spreads, widen the strike prices that we're utilizing within this particular spread. Now, we can by doing that, by widening the spread differential between the two strike prices, we are in fact widening the body of our strategy. And so our butterfly that has a very small butterfly now turns into a condor. So this is where we get that name, because a condor obviously has a wider body than a butterfly. So we still have wings, but the body's wider. The idea is that if we look at this strategy, our objective is still the same. We're looking at these 104 strike call options, and we still believe that the call option is going to appreciate in value over a specific time frame. And at the end of it all, we're still going to pay a premium. Now you can see here I was clipping these examples throughout the day. I think it was yesterday. Yeah, it was yesterday. And so you can see that the cost of each option contract is going up. So anybody that bought the option contract at $2.50, you just made 9 cents throughout the day yesterday, and of course more today. But we're going to pay out the $2 and almost 60 cents for that option contract. We're going to sell these 107 strike call options, and we're going to collect at this point we're going to collect 103. And in order to widen our target on this particular strategy, instead of selling an additional 107 strike call option, we're going to go out and we're going to extend the our strike intervals out to the 108s. And we're going to collect less premium, but you're going to see that now we have a little bit of a wider target area. Now, in this case, we still have to go in and we still have to ultimately look at managing for the risk on the upside. And in this case, we're going to buy the 111 strike call options in order to do so. We're going to give up 87 cents for this particular strategy. Now, the question here, and you'll notice, guys, that again, this is a directional play. So we have to consider, the question was, do we look at exiting the trade as soon as we hit 107? Well, with this strategy, and this again becomes the challenge, very attractive that we lower our risk exposure, but we have to understand that we need a certain amount of time to pass by in order for the profitability of this trade to really be recognized. So unlike that straight call option where if the move happened tomorrow I could just simply take my profits and run, the challenge becomes that I need time to pass by to allow for these sold option contracts to actually lose some time value. So we essentially are going to look at watching this trade over an extended period of time. And of course managing the position, and ultimately from a technical perspective, if we see that maybe it's going to start going against us, we have to make the decision as to whether or not it's appropriate to offset. But at the end of the day, we want some time to pass by before we close this position out. And so again, if we come down here and we just take a look at the position here. And I guess Amanda just had a question here. Why would we and I think her question is, why do we have to wait? Well, we have to understand that if a move happens very quickly on the CDD and no time has passed by, yes, our 104 calls are going to be making money, but the 107s and the 108s are also going to be making money because volatility is going to kick in. And so in the absence of any time depreciation, we're going to see all of these option contracts appreciate in value. Okay? Now, the question here is a profit is a profit, and you're 100% right. And this again is going to be up to the discretion of the individual trading the position. If you feel that you've hit target and you're sufficiently comfortable with the profits, then absolutely take your profits. The way I manage the position is such that as long as it looks like it's going to continue to move in my favor and that we're consolidating within my price range, I'm going to look to allow time to pass by so I can further maximize the profitability on my position, right? So you have to understand, and maybe this will illustrate this a little further, is that what happens when the trade starts moving in our favor is that our 104 strike call options begin to generate intrinsic value, which offsets that the impact of time. In order for us to fully maximize our profits, we need to see these 107 and these 108 strikes essentially expire worthless, because that's when we get to keep the entire premium. So although we're only having to allocate, in this case, $78 or 78 cents because of the fact that we've collected $1.43 and $1.19, we only get to keep $1.43 and $1.19 on expiration, which means the only time that we can recognize the full profit of this position is if on expiration we see the pair trading between 107 and 108, because that means that we have a significant amount of intrinsic value built into our 104 strikes, and the time component of our 107 and our 108s have depreciated such that they're going to expire worthless. Okay? The underlying here, guys, is the CDD, which is the ISE FX option pair value that reflects the US dollar against the Canadian dollar. And so the directional bias that we have is that the US dollar is going to appreciate up against the Canadian dollar over the next several months, and that we are going to trade up to between this 107 and 108 level within our time frame. Okay? So understand once again, though, that we make our profits as we trade towards this level. Our maximum profit is recognized on expiration if the CDD or the U.S. Canadian exchange rate is essentially between $1.07 and $1.08. But if it begins to exceed that, we begin to lose money on this credit spread that we've actually we've established. Okay, so I'm going to move on here, guys. Ultimately, if anybody has any further questions, I want to make sure that I get through everything here tonight, and we're obviously time is passing by quite quickly. So if anybody has any further questions, we'll certainly look at answering them at the end, or anybody can send me an email. But the idea here is what we've looked to do is we've looked to lower our risk exposure and lock in a profit recognized in its fullest as long as the underlying, in this case the CDD, is trading between 107 and 108 on expiration.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.